held up on is the one
I'm
I'm
in with 3
noticing. So see
contracts
what
on
happens when it gets
SPY.
closer.
It's gonna be really light because, man, do not trust this. My stop loss is gonna be. Actually, I'm just gonna
Adam, I feel like it's behind NQ.
Yeah, I was about to say NQ's about to break that high. Tesla's still like
Yeah,
a
you know
little
what?
bit
Looking
away.
at it more, it was holding down for a bit, but it followed like this uptrend, and now it's starting to move.
now. I
So we'll
want
see
to
what
pull back,
happens.
and I want it to hold above this trend line here that I have.
Things look like they want to start breaking out, but I feel like it's gonna wait for Powell.
I'm gonna go ahead and probably scalp this. Just take that. I don't want that.
Or maybe not.
We got room all the way up. Let's see what it does. Honestly, I'm out here. It's FOMC. I'm just gonna take that. I'll get back in a minute, if anything. Thank you, babe. I'm outies. I look to get back in for another scalp at a pullback to 41.56, and I'll look for a play back up. See if I can't lock in on this momentum here. Okay. So what I really want is I need this on my left chart over here. I need this to hold a support. Hold support. And I will get back in with another 3 shares. Sorry, 3 contracts. But this needs to hold up right here. Let's see how well this holds up. It's looking weak. Nope. Let's see if we get a quick change of momentum. A change of momentum for me would be, if you look over to the left side of my charts, you can see I have this trend line here. So about 41.51. If we see a retracement all the way down to that level and it break, then that would be indications of a reversal right here. But this actually is holding up pretty well. Let's see if I can get back in. I'm at 413. Ooh, if we break 41.55,
All right, to
that's my
everybody
stop.
tagging Maki, I promise you, I assure you that he will let us know when he sees
I'm back in.
something, because he wants to signal you guys a big trade just as much as you guys want a big trade. So just have some patience. Don Pablo, I'm fairly confident.
See if we can get these. This quick scalp.
Here goes Tesla again for 165.
We need to break 41.60. It's really what we need to do right now. There we go. There we go.
Is Nor here right now?
Let's see. Let's see if we can hold up right here.
I don't think so.
We need a red to green over here.
Or if he is, he's not on the stage.
There we go. 41.61 is what I'm looking to break through. 41.61, take the profits.
This is like the 4th test of that 165.
There we go. Let's get a break. There it is.
Touched it again right now.
There
See
it
what happens.
is.
I ain't taking it here.
I'm gonna go ahead and take that.
Thing is weird.
Mac, if you think it's worth it, you could text him in the group chat.
There's another setup.
and the various kinds of GSIBs
So I
do
can
as well.
start
So I think it's
sizing in.
healthy to have
I
a
don't want my
you know,
average to be bad.
a range of different kinds of banks.
I have
doing
another
different
setup
Too
right
things.
here.
volatile, so the average needs to be
I
spot
think that's a
on.
positive thing. Is it a financial? So I would just say in
Another
terms of
setup here.
JP Morgan buying First
On
Republic, the FDIC really
I can see
runs
the bottom. I
the
can't.
process of closing
Can't
and
see the
selling
top.
a closed bank completely. That is their role. So I really don't have a comment
So,
on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the
okay.
bid
I'm
that
gonna
is
have
the
to
least
look at
cost bid.
412 puts.
So I would assume that's what they did.
The fact that they're getting larger in general.
Motherfucker.
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing
Oh my
bank.
God,
And
beautiful
I think it's actually a good outcome
Please
for the
don't
banking
fight.
system. It also would have been a good outcome for the banking system had one of the regional banks
412
bought this
puts.
company, and that could have been the outcome. But ultimately,
I want to see
we have to
413
follow the
first.
law in our agencies, and the law is it goes to the
You should be able
least
to
cost
tell
bid.
if this buying is really aggressive or not. It's a real buying.
Thank you, Colby Smith with the Financial Times. At the March meeting, you mentioned that tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Man, this is crazy.
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect.
You better not do it.
But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit,
There it is.
that in a sense restricts
If it flushes, I'm
the
just gonna
economy
pay
through
412.
the price mechanism.
And
And
then 412
you know, when
puts.
banks raise their credit
Let's see.
standards, that can also make credit tighter in a kind of broadly similar
And we're
way.
gonna have to lock
It
in
isn't
these profits.
possible to make a kind of clean translation between one and the
That
other.
was aggressive.
Although firms are trying that, and you know we're trying it, but ultimately we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task.
So we need to
Flush,
reject
guys, I'm gonna pay 412.
4146 right here. We need to
So no
reject
more
this
extra
level.
stuff.
Conceptually, though, we think that interest rates, in
If we don't,
principle,
I'm out.
we won't have to raise rates quite as high. As we would have
4146
if
on
there's
the
not
ES is my
The
stop.
extent of that is so hard to
I'm in 412
predict because
puts.
we don't know how persistent these
And
effects will be. We don't know how large they'll be and how long they'll take to
ooh,
be
I'm
transmitted.
still in them actually.
That's what we'll
God
be
bless.
watching
Should've got
carefully
out.
to find out.
Just to quickly follow up,
It looks
what
like
does
we're
it
gonna hold
suggest about
this
the
as
scope for
support
the
now.
committee
Reclaim
to
it.
pause rate increases perhaps
I
as
hate
early
this
as
area,
next
dude.
month?
Looks like we're
Because
gonna
Given
it's
if the
like
data remains strong,
you've
then
got such a
it's having
fine
some
line
kind of
between
substitute effect.
it's gonna bounce and it's gonna flush.
This is just something that we have to
Oh,
factor
wait,
in
yeah.
as we
My entry is like
want to find
411,
ourselves.
below
So I guess I would say
411.20.
it this way: the assessment
It is weak.
of the extent to which
Let's go
additional
ahead. I want to
policy
add, but I'm
firming may be
not. It's
appropriate is gonna be
FOMC.
an
I'm not
ongoing
I'm
adding.
trying it.
meeting by meeting, and we're
There
going
we
to be
go.
looking at the factors
I
that
got
I
it,
mentioned
I'm
that
in.
are listed
There we go.
in the statement.
Gonna do a light.
The obvious
I'm gonna
factors.
take that.
That's the way we're going to be thinking about it.
Go ahead,
And
take that one.
that's really all we can do. As I say, it does complicate. We have
Oh my
a broad
god.
understanding of monetary policy.
Shoulda
Credit
held
tightening is
that
a
one,
different thing.
Oh my
There's a
god.
lot
Held
of
that one.
literature on that.
Ooh,
Translation
shoulda
Guys, I'm
held that
scaling
one.
out.
to rate hikes is
Good job,
uncertain.
Mackie.
So it adds even further
Oh my
uncertainty. None of
god.
us will be able
Yeah,
to
he's
see
cold.
what's happening with credit conditions.
Bingo.
with lending.
He's cold.
We get there's a lot
Nice
of data
job,
on that,
Mackie.
and, we'll
I
factor
skipped
that
that.
into our decision making.
Oh my god.
Thank you very much, Chirpo. Edward Lawrence with Fox Business. So if the Federal Reserve gets
take
down to the
those.
3% inflation as the projections show at the end of this year, or close to it, would
We're
it
probably
be
gonna see
okay
a
for
bounce
you
here.
for a
This was
prolonged
probably
period of
not a
3%
great
inflation
deal.
and hoping for some outside event to move down to 2% target?
look, I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
We gotta break back
What would
down
you be okay
below.
with a prolonged 3%?
You know what? It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. That's not a question that's in front of us, and it would depend on so many other things. But ultimately,
Oh, he's still
we're not
speaking,
looking to
Kuno?
get to 3%. Drop
What's
our
wrong with
tools.
this guy,
We have
bro?
a
I'm
goal
trying to
of
catch my
getting
movie.
2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're gonna need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate?
Just looking at Newsbot, he's
I
pretty
think
much not saying anything that he
both
hasn't
matter
been saying the
equally at
last
that
like
point.
7
Right
meetings.
now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. Some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Hi, Chair Powell, Matthew Bosa with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed stats forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, where it was even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much
I'm in
as
with
they've
5
declined
contracts.
without unemployment going
It's
up.
actually
Well,
pretty
that's what we've seen. So
more aggressive than I have been
there are no
all
promises
day
in this,
on
but
these scalps.
it just
So
seems that to me that it's possible that we can
I've
continue
been
to have
holding a little
cooling in
longer
the
than
labor market
usual. I should have stopped
without
out
having the big increases in unemployment that
down
have gone
here.
with many prior
I just feel like there's a bigger
episodes,
move to
and that
be
would
made over
against
here.
history. I fully appreciate that. That would be against the pattern, but I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign. Down to more sustainable levels. So
There we go. We have 4140 way down here. We're gonna need to reclaim that.
Stock is done, guys.
Avoiding a recession is, in my view, more likely than
This stock
that
is
of
done
having,
if it
having
holds
a
below
recession.
412.
But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The
Below
committee also
411.80
noted
would
in
be even
March
better.
that wage growth was still well above
Okay, so
levels that would
4144.
be consistent with 2%
We're gonna need to break
inflation.
that.
Do you
If we
see
can
that
start
as well?
breaking
Could you kind of
these little
explain,
levels
how
here.
you come to that judgment?
Sure.
Here we
so
are.
we look at a range
Kinda have
of
it set up. There we
wage
go.
Let's start
measures,
sizing into this
and then
trade.
There we
that's
go.
a nominal. And then so you assume wages should be equal to
412
productivity increases plus inflation. And so you can look at the employment compensation index, average hourly earnings, the Atlanta wage tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run
We're
at
gonna have to
over a
break
long
this.
period of
We're
time
gonna do a quarter position.
for that to be consistent with
Started
2%
there.
inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions
for
where
the
they do
full
go
position
down, where labor gets a bigger
at
share
that
toward
40-cent
later
level.
in a
The
recession.
only issue is we're probably going to
It would start
consolidate
later in
here.
an expansion.
So around
So,
that 40
Yeah,
cent to 80 cent.
you know, when
We're
we
going for
calculate
12
those,
here.
and you have to take the
Probably
precision
going
with
to see
a
some
degree
form of
of
consolidation.
salt, but I would say
And that 40
what they
cents
will
at the
show
double
is
bottom,
that,
we're probably going to see consolidation there too.
If wages are running at
Now we're
5%, 3%
This
is
has a lot
closer
of
to
room.
where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with
This has
inflation
a
over a
lot of
longer
room.
period of time.
To the upside.
By the way,
Right
I
now.
do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move
You want
together,
to see a green to red
and it's
here.
very hard to say what's causing what. But I've
This thing
never
can
said
like
that.
go up to the
you know,
channel,
that-
to the top of the
that
channel right
wages
here.
are really the principal driver. I don't think
Off
that's
of
really
like
right.
80 cents, 90 cents.
Great. Christopher Gaber at Associated Press. When you mentioned profit margins, those did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation,
So the trend is downwards. There might be a bigger play to be made up here to the upside. I really hope not.
And contribute to reduced inflation in the coming months.
Might
So
be a bigger
higher
play to
profits
make
and higher
up there.
margins are what
But the trend
happens
is down.
when you have an imbalance between supply and
But
demand.
that is
Too
a
much
level right there of
demand,
reversal.
not
So
enough
if we
supply.
see that
And
level,
we've
that's
been
a
in a situation
good
in many
indication
parts
that
of
we're
the
fixing to
economy
reverse.
where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal so that we don't have the long waits, the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something
Pretty
about
aggressive.
what your policy
I caught my
reaction
runners.
function is, your
Perfect
policy
timing.
framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition
That was a
backward
break of
looking? Are you
pattern,
going to be
for sure.
forecasting what you think is going
See
to
if we
happen?
can hold it as
Are you
support on the way
ruling
down.
out the rate cuts that the market has priced in?
Let's see.
Didn't catch the last part. Ruling.
Markets have priced in
See if we
rate
can
cuts
hold
by
it.
the end of the year. Do you
Yes.
rule
Sorry.
that out?
Didn't hold it.
I got it. So what are we looking at? I mean, we look at a
Not hold it.
combination of data and forecasts. Of course, the whole idea is
That's
to
the
create a
413
good
rejected
forecast
There we
based
go.
on what you see in the data. So we're always looking at both.
That
And
was a
it will, of
crazy
course, it'll be
push.
the obvious things. It will be readings on
Crazy push.
inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7
We're gonna
weeks
have to
now,
break 41, 48 and
going
like
forward
flush
is
it.
going to be what's happening with
There it is.
with
There's a
credit
flush.
tightening.
41, 48 flush.
Yo, that
Small, medium-sized
413
banks
entry would have been
tightening credit
ridiculous.
standards.
There we go.
And,
You
and
didn't
is
try
that
it?
having an effect on
Nah.
on loans, on lending, and so we can begin to
We're gonna have
assess
to break
how
41,
that fits in
45.
with monetary policy. That'll be an important thing.
Yeah.
We'll be
There we
looking
go.
at everything. It's again, I would
There we
just
go.
point out we've raised rates by
Might be
5
good,
percentage points.
Yeah, it's gonna
We
be the
are shrinking
flush.
the balance sheet, and now we have credit conditions tightening, not just in the normal way,
We have
but
a little bit
perhaps
more
a little
room.
bit more due to what's happened. And we have to factor all of that in.
41, 39, 75.
assessment
Yes, needs to flush.
The real move.
Of whether our policy stance
see.
is
I know what you
sufficiently
mean by that.
restrictive. And we have to
There
do
it
that
is.
Yeah, the dot
where
puts ready.
policy works
Or
with
close.
long and variable legs.
There
So
it
this is
is.
challenging, but we will make our
Flush
best
it, baby,
assessment.
flush it.
11. There we
That's
go.
what we
There we
think.
go. There we
What about
go.
the idea of
There we
rate
What do you think
go.
the entry at 40 cents?
Yeah, so we on the
Took
committee
that.
have a view
Took that.
that
Let's
inflation is
go.
going to
Now I'm
come
gonna
down,
have
Still a key
410.
level here that it
not
could
so
hold.
quickly.
Now I'm gonna have 410
Take some
puts
time.
ready.
We
And
want
in
to see
that
that let
world,
go.
deposits into higher yielding places
Or
such as
1140 is my
CDs
stock market.
and other things, including money
There
market
we go.
funds. So that's a gradual process that
How many
is
puts?
quite natural and happens during a tightening
What is your
cycle. What was
target on
unusual
this?
Flush that.
really was the
Here comes
institutional
way
investors
down
holding their
here.
uninsured deposits and spreading them around and things like that. But
My
it doesn't
target's
seem to have had any
about
effect
409.
on the
Yeah.
overnight repo facility.
409.
That is really there to help us keep rates where they're
409.10
supposed to be, and it's
is a
serving
two-level
that
target.
purpose
Nice add if we
very
break
well.
that 4130 again.
Oh my god, dude.
4130 again.
Sarah Ewald Weiss, CBS
Oh,
News.
no, I'm not
I want to
adding.
go back to the debt ceiling for a moment. I know you
I'm
talked
good.
about that in terms of
Up
fiscal
nicely,
policy.
baby. Up
But can you
nicely.
just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we shouldn't even be talking about a world in which the U.S. doesn't pay its bills.
Here it comes.
It just
There
shouldn't.
it goes.
Bingo. Fourth time go.
I would just say we don't. No one should assume that the Fed can do
Bingo, baby, bingo.
can really
Oh
protect
my
the
god.
economy and the financial
Yo.
system and our
God,
reputation
bro.
globally
Yo, Maki.
from
Maki,
damage
look
that
at this
such
real quick.
an event
How much you
might
up? 10K?
inflict.
Bro, oh my god, I sold so
I sold
early.
way too early.
Alright, guys, I'm cutting it here. I'm cutting most of it here.
In his report last week,
Jesus
way too
Mr.
early.
Christ.
identified a couple of factors that he thought contributed to the regulatory, the supervisory.
Yo, Keith, that's crazy.
11K, yo,
What
let's
the
go,
fuck?
baby.
Yo, we lit.
Call it a sort of cultural shift.
It may just have
And
been
then it's
technology
41.
evolving. We have to keep up with all
14
that. But some
puts
of it
again.
may be our policies and
See what
supervisory,
we could do with
regulatory,
him.
whatever.
We got more room.
What our job is now is to
I'm the
identify
Fed, bro.
those
I don't
things
give a
and
fuck.
implement them. And that's
Yes,
kind of the only
sir.
thing I care about is, and I feel like I am accountable for doing everything I can to make sure that happens.
There we go. Need to break that other one.
It was SPY, guys.
M&I market
I had a
news.
different
Chair
entry
Powell,
than
are we
Maki.
in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
Okay.
Keith, you know I accept tips, right?
So,
Yeah, bro, I tried to offer you
Yes, I would.
lunch last time.
I guess I would say it this way. There were three
Jared, my
large
full
banks really
position
from
was
the
around
very beginning,
412,
that were at the heart of the stress that
and
we saw in
I
early March,
sized
the
in.
severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of is an important step toward drawing a line under that period of severe stress.
4124. If we come back
I
down,
also
I'm gonna
think,
add to it.
we are very focused on what's happening with credit availability, particularly with what you
Nah,
saw in
Fufu,
the
it was total
the
position was
book,
about
and you
10.
will see in the sluice is small and medium-sized, small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the
I'm
macroeconomic
gonna need a
effect of that?
snip.
More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on
Oh, I'm
your
not
own
adding.
actions during this crisis
but
and
I'm
leading
not
up to it over the last. Since you've been Fed Chairman, I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for Supervision, the place to start is the statutory role, which is quite unusual. Vice chair, it says, shall deploy policy recommendations, develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair.
I'm out.
As vice chair for supervision, who really gets to set the agenda for supervision and regulation for the board of governors. Congress wanted that person to have political accountability for developing that agenda. So
Done for the day. Fuck